Hello, this is Aaron Wissner. I'm here with Robert Rapier. Robert, how are you doing today?
I'm good. How are you doing?
Great. So today is February the 2nd, 2021. People are making and losing a lot of money.
They are.
And the big thing in the news has been this GameStop thing. So in the US, there are these stores you can go in and they have video games that you can buy and consoles and t-shirts with Zelda on them and all sorts of stuff like that. My son and I went in one. We were looking for some Wii U games recently. They don't stock them anymore, but it's, I think, my first and only time ever in GameStop. So can you tell us, this stock has went up like crazy and it was way down. What's going on with GameStop, first of all? Who's winning and who's losing?
Okay, so GameStop. Yeah, I was in a GameStop just a couple of weeks ago myself. My wife and I went in looking for something. So GameStop is, they sell games and things like that. A lot of the retailers like GameStop are losing business, to just online downloads and digital companies. And the long-term outlook for GameStop is not good. So a lot of companies, a lot of brick and mortar retailers whose business can be done online, their prognosis is not good. And so over the long haul, it looks like GameStop, is ultimately headed maybe to bankruptcy sometime in the future. So for a company like that it looks like they may be, eventually going out of business, investors can short that company. And what that means is they will sell shares that they don't have, borrowing from the brokerage, with the hope that they'll buy them back later at a cheaper price. And this is what happened with GameStop, except it's a lot of hedge funds that said, okay, GameStop's going bankrupt. It's $20 a share. We're going to short those shares and hopefully it'll go all the way to bankruptcy and we will make $20 a share, or it'll go down to $5 and we'll make $15 a share. And that's the hope. That's what they want to do. The problem with GameStop was the float. That means the amount of shares out there, more than 100% of those shares were shorted. So the short position on GameStop was very, very high. And I heard somebody say, in this case, the dumb money was the hedge funds. You shouldn't be short a position with that many shares short. Why? Because what happens is if the shares start to rise, there's a rush to buy back the shares to cover your position, and there may not be enough shares to go around. And that causes a short squeeze, is what is called, and shares will surge as people try to cover their positions. And the real problem with shorting stock is you have the potential for unlimited losses. If you buy a stock for $20 a share, the most you can lose is $20 a share. If you short a stock at $20, the most you can lose is everything, because there is no upside on how far it can go up. And this is why I'd say never, ever, ever. I don't ever short stocks. It's not for, definitely not for novices. Any trade where you have a limited upside and unlimited downside, that's not a good trade for me. And that's what shorting is. And so what happened was a bunch of retail investors got together on Reddit, and they said, I guess they noticed, how much shares were outstanding. And they said, if we can get this to moving, we can have a short squeeze on this. And that's what happened. And the short squeeze drove shares up. Nothing fundamentally changed with the business. It was just a bunch of people deciding, to buy GameStop shares, and suddenly it causes a price movement. And then the guys that are short have to scramble. And the guys who were short, they've lost, billions and billions of dollars. And the problem is you can't ride out those losses, because the brokerage will close those accounts before they get too horrendous. If you're short at $20 and shares go to $100 and then $200, you may think you can sit tight, but your paper loss is getting higher and higher and higher. And at some point, the brokerage is going to protect themselves, and they're going to sell those shares out from under you. And so a lot of that happened.
So this reminds me of two things that we've talked about before. Number one is that oil price spike in 2008, where the price went way up and then it collapsed.
Yep.
During the summer. And then the other one was back earlier in, what was it, April, where the price of oil went down negative.
Yep.
Now, are these in any way related, or how are they related?
So temporarily, things can get very disconnected from fundamentals. And what happened with oil last year, going to negative, $38 a barrel, that is not a fundamentally sound price point. But it's somebody desperately needing to unload positions. If you have many more sellers than buyers, you can temporarily have that sort of disconnect. And so when you see GameStop trading at $400 a share, when a month ago it was 17, and nothing fundamentally changed in the business, that's the sort of situation where you have a fundamentally unsupportable price. And I think now shares are down 70 or 80% over the past week. It wasn't a sustainable situation. And so, a lot of people say, yeah, stick it to the hedge funds. And, we made the hedge funds go bankrupt. But individual investors buying in at 400 and now seeing shares, I think they were back below 100 today. They're getting hurt. It's not just the hedge funds. Anybody trying to jump in and out here can get hurt really badly on this trade. So, this is like gambling. I mean, this is not fundamental. There was a level of fundamental analysis, I guess, when they identified that, hey, there's a very, very large short position. If we can start to make this move, we can maybe profit a little bit. And once shares take off and they go up 100, 200, 300%, there's nothing fundamental anymore. It's completely disconnected from fundamentals. And when that happens, you're gambling. And I don't like to gamble. So I've advised people to, either sit this out or do something that has a defined risk reward scenario. And that's what I've told people. I said, if you want to trade it, I can tell you how to trade it, but don't just buy and sell shares.
Before we do that, because I do want to get to that, because I think it's interesting. Now, over the last week or month for GameStop, for example, who is making the money here? Because the money is going in, right? People are buying these stocks. Right. They're actually buying these stocks and they're buying the options. They're selling the options. So who is making the money? Who is taking the money out? Because that money is going somewhere, and there's a lot of small investors who are putting the money in. But where is that money going to? Because someone is making out big. They must be.
So the people who originally identified this strategy and bought in, and I read about one of them that bought in at like $5 a share. They saw share price go from $5 up to, I think, at $480 at one point. Now, on paper, a guy who bought at $5, became, had a huge return on his investment. Now, if he sold it, he cashed out and he made some money. But he could be riding that all the way back down. I mean, I know people who've ridden a position up, to $2-3 million and ridden it all the way back down to zero. I mean, that happens. So, anybody that did get in, they should have been selling positions during the rise. You never know how high it's going to go, but you don't want to ride a position like that all the way up and then all the way back down. So there were probably people who, made some money off of options. But the option market kind of went crazy. I mean, it went absolutely crazy on GameStop. And, we can talk about that in a minute, because that's where you could have made some money at pretty low risk. But anybody who bought in low and sold out, or, somebody who did short when it was at $300 or $400 a share, they've made a lot of money, but they made it at a very, very high risk. Even, if you shorted at $300 and it spiked on up to $480, at one point you're down $180 a share on your $300, short. So it's just a very, very risky thing. When you short stock, you have to be right on the direction that it's going down, but you also have to be right on the timing, because if it spikes before it goes down, it'll take your position out.
This reminds me of two things. Number one, it reminds me of going to a casino and you go in with your $100 or whatever, and you double it and you double it and you double it and you double it and you double it, and then you lose a few times, you lose a few more times, and you leave it empty. You know, you don't
Right.
have any money left in
Right.
your pocket. Or you go, gamblers that go to the casino multiple times, you know, over years and years, and you know, they are really excited about the big gains they had. You know, I won $30,000
Right.
once, but so that's one of the things that comes to mind. The other thing that is it similar?
Yeah, I think we tend to remember our big gains like that, and we kind of discount our losses. And over time, you know, the casinos are the ones that make money. That they make money. Individual people that come in and out, they make money, they lose money, but on average, they lose money. I mean, that's how the casino makes money, is most of the people on average coming in lose money.
It seems like the people that were encouraging, like on the Reddit forum, that were encouraging people to buy and hold, buy and hold. If there's some of those people that bought the stocks at $5 or $10 or whatever, I mean, if they stand to gain, if it doubles or multiplies, and it's like a Ponzi scheme, kind of like they're getting the people to buy into the Ponzi scheme, so they are able to cash out, and then the people who are losing are the people who get in last.
Yeah, this pump and dump stuff has been around for a long, long time. Thinly traded companies on message boards get hyped up all the time by people who bought a small position, hyped that company, you know, tried to get a movement and then get out. But remember, even the people who bought in, they don't know how high it's going. They don't know how fast it's going to come down. So they didn't even necessarily make as much as you think. I mean, even though shares went from like 5 to 480, they didn't have the foresight to know when to sell. So, you know, they probably made some money, but they may be still holding on. I mean, you know, somebody could have bought in at $5 and they're still holding, and they've made a lot of money, but they lost a lot from where they were at a week ago.
So now, anytime I see big price changes in stocks or whatever, I'm always thinking to myself, there's got to be a way to make a bet where you're betting that it's going to go back to normal without having these unlimited losses. And so
Right.
this is something that you did yourself
Right.
with a GameStop position. Can you explain what you did?
Yeah. So GameStop started the year at about $17. And so
2021.
2021, that's just, you know, 4 weeks ago. That's just a month ago. So let me talk about options for just a second. You know, if you buy a call option, it gives you the right to buy a share or 100 shares, one call option, buy 100 shares of a company at a defined price at a defined point in the future. So I could have bought a call option on January the 3rd or 4th for GameStop for $30 in, you know, 6 months from now, and I could have paid maybe $1 or $2 for that call option. That gives me the right to buy GameStop at some point in the future, and I can exercise that option whenever, and I can also sell that option. Now, if you bought a $30 call option for GameStop on January, first week of January, at one point you had just phenomenal gains. I mean, I don't even know, you may have paid $2 for that call option and it went to, you know, $300 or $400. So options can make you a lot of money, but they can also lose you a lot of money. Most people who trade options lose money. A put option allows you, if you are the owner of a put option, to sell shares at a certain price in the future. So if I buy a put option, so say I buy a $20 put option on GameStop, I may pay $2 for that. And that's giving me the right to sell, say, at $20 3 months from now. And the person who's selling me that, they are guaranteeing me that they will buy those shares at $20 at some time in the future. Now they're betting the share price is going to be higher. And I am betting, or I'm hedging against a big loss. So I hold a GameStop position and I'm hedging that. So basically I'm buying insurance. So with that little bit of terminology, here's what I did. When GameStop shares went up so much, I looked at the options on GameStop and they were insane. When GameStop was $300 a share, and so $300 a share, you might say, I want to lock in some of these gains and I want to give it a chance to go higher, but I want to protect my downside. And you could buy a put option. And let's say you wanted to protect yourself at $200. So I want to lock in $200. I want to buy a put option that allows me to sell my shares at $200. How much is that going to cost me? Well, in a normal market, a put option that's that far below the current price is not going to cost you that much money. $5, $10, $20 maybe for that put option, depending on how far out. I checked, and the put options on GameStop for that sort of trade were $150. I mean, it was an insane price for these options. And I thought,
normally, Robert, if you bought a put option for a $200 stock,
yep,
you'd expect that to be what, 1% of
it
the price?
depends on the volatility. Yeah, it depends on the volatility of the company. But yeah, you're paying, 2, 3, 4, 5% premium to protect that. And it also depends on how far out of the money, how far below the price you buy. If you got a $200 company and you buy a put option at $10, you can get that for pennies. There's almost no chance that's ever going to be executed on most companies. So the person selling it is just generating money. I mean, they're generating money at almost no risk, but it's pennies. They're generating pennies. So I looked at the put options for GameStop. Now, if I had to guess, I don't know if there's a way to go back and look and see what put options were priced, but if I had to guess, when GameStop was trading at $17, a $17 put option for November would have probably been $1 or $2. You would have probably paid that much to make sure that you still got $17, and maybe it's $3, but it's not something crazy. So I started checking lower and lower prices when the share price was around $300. And for a $17 put option, the premium on that option was $6.50. Now that's a very, very high, especially when shares are trading more than $300. That's a very high premium for somebody to pay to guarantee they'd be able to sell their shares at 17. That's 40% of the price. So I sold a put option. I sold 6 put options for GameStop. And what that means is I collected $650 per contract, and that obligates me to buy GameStop shares for $17 in November if they are below $17. If they're above $17, I make the maximum profit of nearly 40%. If they're below $17, and again, they started the year at $17. That's why I made the trade for $17. I looked at where they were before all the craziness. And if I have to buy GameStop shares, my net cost is $17 minus $6.50 because I already got $6.50 premium. So, for $10.50, I will have a position in GameStop in November if shares are below $17. So I make maximum profit as long as shares are at least $17, and I lose money if shares are below $10.50. So it's not an absolute fail-safe, but it's a much, much lower risk. I mean, you're talking about nearly 40% in 10 months, and the downside is pretty limited. The most I can lose on a contract, so one contract for $17 cost me $1,700 minus the premium. So $1,050 per 100 shares, that's the maximum I have exposed here. So I can't lose more than that. And, I believe shares will probably be 17 or higher. The only reason they got driven down to such a low level is you had that huge level of short selling. And I don't think the short sellers are going to pile back into this one. I mean, they got burned pretty bad on this one, and I think they'll be pretty cautious about piling back in. Now, like I said, it's not a risk-free trade, but it is, 40% in 10 months versus what I deem a pretty small risk and an acceptable risk to me. The risk that I will have to buy 600 shares of GameStop in November, that's okay. Because what will happen is if I do get assigned shares, I'll turn around and sell a call option on them. So, I'll drive my share price down even further. So to me, it's pretty low risk way. I spelled it out in an article for Investing Daily, exactly how to do it. And the trade is not there still where it was a week ago, but it's already paid out 22%. And if I close my position today, I will make 22% on the money that I risked in 6 days.
Do you see, so you must, when you're thinking about using an option in this way, you must be thinking, hey, the upside is possibly 38, 40% in whatever, 8 months, you said. The downside is, I own these stocks and I've got to do something with them.
Yep, and they could go to zero. My downside is the share price could go to zero, but
the company could go bankrupt.
They could go bankrupt. The downside is I'm going to own 600 shares of GameStop in November if the price is below $17. But that's a known risk. That's a known quantifiable risk. And those are the kind of risks I like. When you short a stock, you do not have a known quantifiable risk. You've got an unlimited risk.
So what makes you feel that GameStop wouldn't go bankrupt by then? I mean, if it's mostly a brick and mortar store that's selling video game discs, which are used less and less by today's consoles, what gives you the impression that it's not going to be bankrupt or far below $17? Because
the revenues weren't going down fast enough to justify that. I looked at the revenues over the past 6 or 8 years, and they are steadily declining, but they are headed towards zero unless GameStop figures out a way to stay in business. And they have been closing stores. They have been trying to figure out ways, but a lot of people say they're going to go just the way of Blockbuster Video, and that's why this seemed like such a no-brainer short trade.
But they have a pretty good online presence. I looked at their website, and yep, you could buy downloadable video games or used discs through the website. So yep, they could reduce their brick and mortar footprint and still have a viable business.
Right. They will still be a company. They're unlikely. I mean, they could pivot and do just what you said, more and more of that. And then how big is the company at that point? I don't know, but I felt like the risk is low that they will be, especially going as high as they did. It usually drifts down. I thought it would come back down pretty fast from $300 to $400. But once it gets below 50, I think it'll be a slower ride down to 20. I don't see it being back to $20, real soon. Now maybe it will, but then I've still got 10 more months to ride this trade at. It may go down below $17 between now and then, but I'm just betting that it's at least $17 or, well, actually, I'm betting that it's at least $10.50 because above $10.50, I made profit. It's just that I made maximum profit above 17. And I could unload my position right now. I mean, I could unload it and I made 22% in 6 days, and that's not bad.
So what about the economics in general in the U.S. right now, as far as the economy and a possible $2 trillion stimulus? Does that possible support for businesses and small businesses, maybe, does that give you any additional hope for companies like this, that they'll make it through the year, where they might, the fundamentals, you might look at them and say, that's not going to last another year, but given what's going on
if there's a bunch of stimulus injected into the market and we have, more bull market, it makes it better, for that trade. It's, it's harder for companies to go down when the whole market is roaring higher. And yeah, I mean, if we do get more stimulus, and I have some worries about what we're doing to the deficit, but I think it's unquestionable that injecting that kind of stimulus into the economy is good for the stock market and good for businesses.
Sure. So if you were talking to on the Reddit forum, what would you say? So you're on there, you're just talking to the people that are on there. I mean, would you say, only do these certain options if you're going to stay on GameStop, if you're going to look at AMC, if you're going to look at silver, what would you say to these people that maybe they're in their 20s and they get their stimulus check or whatever, their unemployment check, and they're like, I'm going to put this in Robinhood, and what would you say to them?
I would say if you are in your 20s and you have regular disposable income to invest, you can be a millionaire almost certainly doing it slowly, steadily, and patiently. But if you're rolling the dice regularly, you're going to have a lot of boom and bust, and you'll be like the person in the casino. And you'll remember you had some big wins, but you had some big losses too. And, I've done it the slow and steady way. I've over the long haul, if you had just done at the average rate of this S&P 500, just about anybody can be a millionaire, in 30 years of investing. So if you're in your 20s, I'd say, develop a plan. And, that's not very exciting for some people, but slow and steady with a high rate of probability of success is the way I prefer to do it. And that's what I counsel people to do. And I would say, don't go piling in there. There's too much volatility and there's too much chance that, we can all look back and say, wow, wish I'd bought, wish I bought GameStop at $5 and sold it at 400 and I'd be very, very rich. But nobody has that kind of foresight. Nobody knows, when it's going to take off or if it's going to take off and when it's going to turn around. There's a very famous story I may have told you before. A secretary at Enron put all of her money into Enron stock. All her retirement was in it, and she rode that up to $3 million. At one point, she was worth $3 million, and she ended up losing all of it. And I counsel people, look, it is possible to have some huge wins, but you've got to take that money and diversify it and get it out of a single position. You can't put all your eggs in one basket like that. If you can't afford the risk, if you can't afford the downside, don't take that risk. I've got a friend who works for a company. He got some stock options and the stock price, shot up very high. And he said, what should I do? And I said, well, you got to think about, can you sustain if your company went bankrupt? Is that all your wealth? Is all your wealth tied up there? Because it doesn't matter what the upside potential is if you can't afford the downside. You don't play Russian roulette like that. If that is your retirement, you have to get some of that money out and get it diversified. And, maybe your share price goes to $1 million and you say, wow, look what I could have had. But you're trying to protect the downside. It's like living in a house without, any homeowner's insurance. And you may go 30 years and say, wow, I spent a lot of money on premiums. Well, but if your house is burned down, it would have been a devastating event. So you don't fly, blind. You don't fly without protection like that.
How often do you find this sort of what appears to be a low risk, high reward situation? So you bought these options or you sold these options this month, yep. January, February. I mean, in the last year, how often do you see stuff like that come up?
Whenever you see a company with really high volatility. I mean, I also did a Blackberry trade during this. Same sort of deal, same sort of risk return, defined risk. You can find a lot of opportunities like this, but it's always with companies that have an issue. You have this sort of volatility. There's a reason for that volatility. you've got people betting that it's going to go up and betting it's going to go down, and that whipsaws a company like this. So these sorts of trades, I mean, they often, you know, it is a company that's going to go bankrupt. And so in this situation, you know, I had to make a calculated risk. I don't think they're going to go bankrupt by the end. I think they'll still be, you know, a viable company later on in the year. But you can find a trade like this just about every day. You can find something, but it doesn't necessarily have the same, you know, you may be looking at a company that will almost certainly be bankrupt in November, and you may have a, you know, 40% potential return against, you know, 100% loss. I mean, that may be what you're looking at. So in this case, the risk reward didn't look like that. So anytime I see that kind of market volatility, I start looking at the options and look at, you know, what's happening, and is there a way to profit at a low risk here, no matter what happens. I knew the share price would come down. And usually if you have sold a put option, that's not what you want to see. Because when the share price starts coming down, then the risk increases that your put is going to get assigned. In this case, even though the stock price is way, way down, my put options have actually made money. Now that's a total inverse of what you'd normally see. And it's just a function of how out of whack these prices got, these option prices got when the share price went up so much.
One last question before I leave you, Robert, and thank you for your time. So the people who are buying this stuff right now, who are saying buy and hold, buy and hold, buy and hold, what are your thoughts on that? Well,
I mean, I absolutely wouldn't buy a company like GameStop here to hold it. You know, with this, I mean, they were saying that, you know, there was a guy last week on Seeking Alpha wrote an article that said, now's the time to short GameStop at $65. Well, if you took his advice, you lost more than $400 a share on that $65. And conversely, if somebody's saying buy and hold right here, buy and hold, well, if they said that day before yesterday or end of last week, buy and hold, we were buying for $300. And what's the share price at now?
Like 98.
Yeah. So yeah, it closed at $90 today. It was down $135. So if you bought yesterday at $200, you've lost half your money. So, you know, the best thing I would say is stay away from companies like this. A few guys who did get in early and advance the thesis, hey, this thing is overshorted and could be subject to a short squeeze, those guys made money. But once the share price has skyrocketed, the best thing to do is just leave it alone or look for a sort of a more creative way to make money off of it.
All right. Thank you so much again for your time, Robert. I always appreciate your insight. If you appreciate Robert's time here and this content, please click like and subscribe, and we'll see you next time. Bye-bye.
All right, take care.